The Fed is signaling potential rate cuts. Inflation is near target, and the unemployment rate is seemingly stable. So why are some economists still so worried? Let me walk you through the risks that could derail this economic balance. Risk number one, tariffs. Here's the mechanism that's already in motion. Ahead of tariff implementation, imports surged as businesses rushed to stock up on foreign goods before prices rose. This created a temporary buffer, delaying cost pass-through to consumers. But as those inventories deplete, price pressures will emerge. The Fed must now weigh supporting growth while staying vigilant about inflation. It's a particularly challenging form of price pressure to combat because it's policy-driven, not market-driven. Risk number two, price growth may be back to target for now, but prices haven't come down. Here's the data that tells the story. 20% down on the typical home went from $51,000 to $71,000. That's an average annual growth of over 8% over the past 5 years. Rent and food, 5%. Wage growth, just 4% for 5 years. So we're back to target growth, but that's what we're dealing with now. Even with stable macro indicators at a broad national level, consumer confidence remains fragile because budgets are still stretched, and individual industries and markets, from tourism and agriculture to AI applicable information jobs, are starting to hurt, even as other industries continue to grow. So broad national employment numbers, they can hide a lot of pain, but the Fed only has broad national tools. Risk number three, and perhaps most significant, threats to institutional independence and data integrity. The Fed's effectiveness depends on making decisions based on economic data, not political considerations. Similarly, organizations like the Bureau of Labor Statistics provide critical economic data through rigorous methods. Every research team, every market research team, from private companies to think tanks, even your favorite private data providers, rely on BLS data as inputs or benchmarks. Bad data reduces the effectiveness of your business decisions made on the numbers you crunch or hear. So where does this leave us? An independent Fed is committed to steady as she goes, to the balance. Their toolkit provides mechanisms for general response, but they can do little about rising inequality or tariffs' disparate impact on specific groups. The Fed's tools are broad, untargeted, and powerful, and to be used carefully. So for mortgage market participants, expect relative stability with gradual adjustments rather than dramatic swings. Rates may decline as the Fed moves towards neutral, but don't expect a big break as other risks can keep upward pressure on rates. The focus for people building in prop tech should be on sustainable, long-term affordability solutions that don't depend solely on monetary policy accommodation. This has been In Data She Drops, where we tackle the complex economics behind your biggest financial decisions.